Question 1. Research into the effectiveness of a firm's risk management framework reveals a significant disconnect between the board-approved risk appetite statement and the day-to-day operational decisions being made by various business units. Senior management has expressed concern that the firm is taking on risks that exceed its stated tolerance levels, yet no formal process is in place to reconcile these discrepancies. Which of the following approaches best addresses this challenge in aligning risk appetites? Option A. Implement a comprehensive risk appetite framework that clearly defines risk tolerances at both the strategic and operational levels, supported by robust monitoring and reporting mechanisms, and establish a regular review process involving all relevant stakeholders to ensure ongoing alignment. Option B. Rely on the existing risk appetite statement as a guiding principle and assume that business unit managers will exercise sound judgment in managing risks within acceptable parameters. Option C. Allow each business unit to develop and operate under its own risk appetite, provided that the aggregate risk profile remains within broad regulatory guidelines. Option D. Focus solely on enhancing the firm's capital adequacy to absorb potential losses, thereby mitigating the impact of any deviations from the stated risk appetite. The correct answer is A. Implement a comprehensive risk appetite framework that clearly defines risk tolerances at both the strategic and operational levels, supported by robust monitoring and reporting mechanisms, and establish a regular review process involving all relevant stakeholders to ensure ongoing alignment. Explanation: this scenario presents a professional challenge because it requires a firm to balance the strategic objectives of senior management with the practical realities of risk management and regulatory compliance. The core difficulty lies in ensuring that the stated risk appetite is not merely a theoretical construct, but is actively embedded within the firm's operational processes and decision-making. Misalignment can lead to excessive risk-taking, regulatory breaches, and reputational damage. Careful judgment is required to identify and address these discrepancies effectively. The correct approach involves a structured and iterative process of aligning risk appetites across different levels of the organization. This begins with a clear articulation of the firm's overall risk appetite by the board, which then cascades down to business units and individual functions. Crucially, this alignment must be supported by robust risk management frameworks, appropriate controls, and regular monitoring and reporting. The firm must demonstrate to regulators that its risk appetite is not just a document, but a living principle that guides behavior and decision-making, ensuring that risks taken are within acceptable boundaries and that the firm can absorb potential losses. This aligns with the principles of good governance and risk management expected by regulatory bodies, which emphasize the importance of a strong risk culture and effective oversight. An incorrect approach would be to assume that a documented risk appetite statement automatically translates into effective risk management. This fails to acknowledge the need for practical implementation and embedding within the firm's operations. It also overlooks the regulatory expectation that firms actively manage their risks in line with their stated appetite. Another incorrect approach is to allow individual business units to operate with significantly divergent risk appetites that are not reconciled with the firm's overall strategy. This creates a fragmented risk profile and can lead to uncontrolled risk accumulation in certain areas, potentially exposing the firm to unacceptable levels of risk. Furthermore, focusing solely on compliance with minimum regulatory requirements without considering the firm's specific strategic objectives and risk-taking capacity would be an inadequate approach. This reactive stance fails to proactively manage risk and align it with the firm's business model. Professionals should adopt a decision-making framework that prioritizes a holistic view of risk. This involves understanding the firm's strategic goals, identifying the key risks associated with achieving those goals, and then defining a risk appetite that supports these objectives while remaining within the firm's capacity to manage and absorb losses. Regular communication and collaboration between senior management, the board, risk functions, and business units are essential. Furthermore, professionals must ensure that risk appetite is translated into actionable policies, procedures, and performance metrics, and that these are regularly reviewed and updated in response to changes in the business environment or regulatory landscape. Question 2. To address the challenge of ensuring effective and proportionate implementation of continuous monitoring systems for regulatory compliance, a financial firm is considering several approaches, which approach best aligns with the principles of robust risk management and regulatory expectations under the FCA's framework. Option A. Implement a fully automated system that flags any deviation from predefined parameters, with no requirement for human review of alerts. Option B. Install a basic monitoring system that was initially effective but has not been updated in several years to reflect current business operations or regulatory changes. Option C. Deploy a system that generates a high volume of detailed alerts, requiring all staff members to periodically review a broad range of notifications to foster a culture of awareness. Option D. Develop a comprehensive system that integrates automated alerts with a dedicated team of trained compliance officers responsible for reviewing, investigating, and escalating potential breaches. The correct answer is A. Implement a fully automated system that flags any deviation from predefined parameters, with no requirement for human review of alerts. Explanation: this scenario is professionally challenging because it requires a firm to balance the imperative of robust risk control with the practicalities of resource allocation and the potential for over-reliance on technology. Implementing continuous monitoring systems is a critical component of a firm's overall control framework, aiming to detect and prevent breaches of regulatory requirements and internal policies in real time. The challenge lies in selecting and implementing a system that is both effective and proportionate, ensuring it genuinely enhances control without becoming a bureaucratic burden or creating a false sense of security. Careful judgment is required to ensure the system aligns with the firm's specific risk profile and regulatory obligations. The correct approach involves a comprehensive, risk-based implementation that integrates human oversight with automated alerts. This means designing the system to flag potential issues based on predefined thresholds and patterns, but crucially, ensuring that these alerts are reviewed by appropriately trained personnel who can exercise professional judgment. This approach is justified by regulatory expectations, such as those found in the FCA's Senior Management and Systems and Controls (SISC) sourcebook, which emphasizes the need for firms to have adequate systems and controls in place to manage risks. Continuous monitoring, when properly implemented with human oversight, directly supports these requirements by providing timely detection of control weaknesses or breaches, enabling prompt remediation, and demonstrating a commitment to regulatory compliance. It also aligns with ethical duties to act with integrity and due skill, care, and diligence. An approach that relies solely on automated alerts without human review is professionally unacceptable. This failure stems from a misunderstanding of the limitations of technology. Automated systems can generate false positives or miss nuanced breaches that require human interpretation. This could lead to regulatory breaches going undetected, violating the firm's duty to maintain adequate controls and potentially exposing clients to harm. It also fails to demonstrate the due skill, care, and diligence expected of a regulated firm. Another incorrect approach is to implement a system that is overly complex and resource-intensive, leading to alert fatigue and a diminished capacity for effective review. While thoroughness is important, a system that generates an unmanageable volume of alerts can become counterproductive. This can result in genuine issues being overlooked due to the sheer volume of notifications, undermining the purpose of continuous monitoring and potentially leading to regulatory breaches. It suggests a lack of proportionality and effective risk management in the design and implementation of the control system. A third incorrect approach is to implement a system that is not regularly reviewed or updated to reflect changes in the firm's business, products, or the regulatory landscape. Continuous monitoring systems must evolve. Failing to do so means the system may become outdated, failing to detect new or emerging risks. This demonstrates a lack of ongoing commitment to risk management and regulatory compliance, which is a significant ethical and regulatory failing. The professional reasoning process for similar situations should involve a thorough risk assessment to identify key areas for monitoring, followed by the design of a monitoring system that is proportionate to the identified risks. This design must incorporate clear escalation paths and defined responsibilities for alert review and action. Regular testing and validation of the system's effectiveness, alongside ongoing training for personnel involved in monitoring, are essential. Furthermore, firms should establish a process for periodically reviewing and updating the monitoring system to ensure its continued relevance and effectiveness in light of evolving business activities and regulatory requirements. Question 3. Analysis of a decision tree designed to assess the risk of unauthorized access to client data, which approach best demonstrates adherence to the principles of effective risk control within the CRM Control of Risk Exams regulatory framework. Option A. Implementing the least expensive control measures identified at the initial decision points of the tree, assuming these will cover most scenarios. Option B. Focusing exclusively on the branches of the decision tree that have occurred most frequently in the past, irrespective of their current or future potential impact. Option C. Prioritizing control measures based on the branches of the decision tree that represent the highest potential financial impact, even if those branches have a lower probability of occurring. Option D. Developing control measures that address the most probable outcomes identified in the decision tree, while also considering the severity of their potential impact. The correct answer is C. Prioritizing control measures based on the branches of the decision tree that represent the highest potential financial impact, even if those branches have a lower probability of occurring. Explanation: scenario analysis. This scenario presents a professional challenge because it requires a risk control professional to move beyond a superficial understanding of a decision tree and apply its principles to a complex, real-world situation involving potential client harm and regulatory breaches. The challenge lies in accurately identifying the critical decision points, potential outcomes, and the associated probabilities and impacts, all while adhering to the strict regulatory framework of the CRM Control of Risk Exam. Failure to do so could lead to inadequate risk mitigation strategies, regulatory sanctions, and reputational damage. The professional must exercise sound judgment in interpreting the decision tree's output and translating it into actionable control measures. Correct approach analysis. The correct approach involves systematically evaluating each branch of the decision tree, considering the likelihood and impact of each potential outcome, and then prioritizing control measures based on the severity of the risk. This aligns with the core principles of risk management, mandated by the CRM Control of Risk Exams regulatory framework, which emphasizes a proactive and structured approach to identifying, assessing, and mitigating risks. Specifically, the regulatory framework requires firms to implement robust systems and controls to prevent financial crime and protect clients. By using the decision tree to identify the highest risk scenarios and then tailoring control measures to address those specific risks, the professional demonstrates adherence to the control of risk mandate. This approach ensures that resources are allocated effectively to the most critical areas, thereby optimizing the control environment and minimizing the potential for regulatory breaches and client detriment. Incorrect approaches analysis. An approach that focuses solely on the most frequent outcomes, regardless of their potential impact, is incorrect because it neglects the principle of proportionality in risk management. The regulatory framework requires consideration of both likelihood and impact. Ignoring high impact, low likelihood events could leave the firm vulnerable to significant losses or regulatory censure. An approach that prioritizes control measures based on their cost-effectiveness without first assessing the associated risks is also incorrect. While cost is a factor in implementing controls, the primary driver must be the level of risk identified. Implementing cost-effective controls for low-risk activities while neglecting high-risk areas would be a clear violation of the duty to control risk effectively. An approach that relies on anecdotal evidence or past experience without systematically analyzing the decision tree's outputs is flawed. While experience is valuable, the decision tree provides a structured, data-driven framework for risk assessment. Deviating from this framework without a clear, justifiable reason, especially when it leads to a less comprehensive risk assessment, would be a failure to adhere to the systematic risk management requirements. Professional reasoning. Professionals should approach decision tree analysis by first clearly defining the problem and the objectives. They must then identify all relevant decision points and potential outcomes, assigning probabilities and impacts based on available data and expert judgment. The next step is to analyze the expected value or risk exposure at each node and branch. Crucially, the insights gained from the decision tree must be translated into concrete, proportionate, and effective control measures that align with the firm's risk appetite and regulatory obligations. Regular review and updating of the decision tree and associated controls are also essential to maintain their relevance and effectiveness in a dynamic risk environment. Question 4. The investigation demonstrates that a financial services firm is experiencing significant delays in client onboarding due to its current due diligence processes. To address this, management is considering implementing a new control framework. Which of the following approaches best aligns with the regulatory requirements for developing controls to mitigate process risks in the UK financial services sector? Option A. Streamlining the due diligence process by reducing the number of checks and documentation requirements for all client types to expedite onboarding times. Option B. Implementing a tiered due diligence process that categorizes clients based on a comprehensive risk assessment, allowing for the application of proportionate controls, including enhanced due diligence for higher-risk clients. Option C. Standardizing a single, comprehensive due diligence process that all clients must undergo, regardless of their perceived risk profile, to ensure consistency and reduce complexity. Option D. Delegating the entire due diligence process to third-party providers without establishing internal oversight or validation mechanisms. The correct answer is B. Implementing a tiered due diligence process that categorizes clients based on a comprehensive risk assessment, allowing for the application of proportionate controls, including enhanced due diligence for high-risk clients. Explanation: this scenario is professionally challenging because it requires a firm to balance the need for efficient client onboarding with the imperative to adhere to stringent anti-money laundering (AML) regulations. The pressure to onboard clients quickly can create a temptation to bypass or streamline controls, which directly conflicts with the regulatory requirement to conduct thorough due diligence. Careful judgment is required to ensure that risk mitigation strategies are effective without unduly hindering legitimate business operations. The correct approach involves developing a robust risk assessment framework that categorizes clients based on their inherent risk profile. This allows for the tailoring of due diligence measures, applying enhanced due diligence (ED) to high-risk clients and simplified due diligence (SDD) where appropriate and permitted by regulation. This approach is justified by the UK's money laundering, terrorist financing and transfer of funds, information on the payer, Regulations 2017, MLR 2017, which mandate a risk-based approach to customer due diligence. Regulation 18 of the MLRs 2017 specifically requires firms to identify and assess the risks of money laundering and terrorist financing to which they are subject. By developing controls that align with this risk assessment, the firm ensures compliance and effectively mitigates potential risks. An incorrect approach that relies solely on a single, generic due diligence process for all clients fails to acknowledge the varying levels of risk associated with different customer types and jurisdictions. This is a regulatory failure because it does not adhere to the risk-based approach mandated by the MLRs 2017. It could lead to insufficient scrutiny of high-risk clients, thereby increasing the firm's exposure to financial crime. Another incorrect approach that prioritizes speed of onboarding over the thoroughness of due diligence is a direct contravention of the MLRs 2017. This approach creates a significant ethical and regulatory risk, as it suggests a willingness to compromise compliance for commercial expediency. It demonstrates a failure to embed a culture of compliance and risk management within the firm. The professional decision-making process for similar situations should involve a systematic evaluation of regulatory requirements, an assessment of inherent business risks, and the development of proportionate controls. Professionals must prioritize compliance with the MLRs 2017, ensuring that their risk assessment process is comprehensive and that the controls implemented are effective in mitigating identified risks. This involves regular review and updating of policies and procedures to reflect evolving risks and regulatory expectations. Question 5. During the evaluation of a confidential report submitted by a junior employee alleging serious financial irregularities by a senior manager, what is the most appropriate immediate course of action for the compliance officer to ensure adherence to whistleblower protection regulations and maintain a fair investigative process? Option A. Immediately initiate a formal, confidential investigation into the alleged irregularities, while simultaneously assuring the reporting employee of their protection against retaliation and the firm's commitment to confidentiality. Option B. Advise the reporting employee to gather more concrete evidence independently before the firm can act on the report. Option C. Inform the reporting employee that while the firm takes all allegations seriously, the nature of the report requires them to identify themselves to the senior manager to facilitate a direct resolution. Option D. Schedule a meeting with the senior manager to discuss the allegations and seek their perspective before proceeding with any formal steps. The correct answer is A. Immediately initiate a formal, confidential investigation into the alleged irregularities, while simultaneously assuring the reporting employee of their protection against retaliation and the firm's commitment to confidentiality. Explanation: this scenario is professionally challenging because it requires balancing the firm's operational needs with the legal and ethical obligations to protect individuals who report potential misconduct. The compliance officer must navigate a situation where a subordinate's report, if true, could have significant implications for the firm, while also ensuring the whistleblower is not subjected to retaliation. Careful judgment is required to initiate a thorough investigation without prejudicing the accused or compromising the whistleblower's identity, adhering strictly to the principles of fairness and confidentiality mandated by regulatory frameworks. The correct approach involves immediately acknowledging the report, assuring the whistleblower of their rights and the firm's commitment to non-retaliation, and initiating a confidential, objective investigation. This aligns with the spirit and letter of whistleblower protection regulations, which aim to encourage reporting of wrongdoing by safeguarding those who come forward. Specifically, regulatory bodies emphasize the importance of prompt and impartial investigations and the prohibition of retaliatory actions against whistleblowers. This approach upholds both legal compliance and ethical conduct by prioritizing the integrity of the reporting process and the well-being of the individual. An incorrect approach would be to dismiss the report without a proper investigation, perhaps due to the perceived inconvenience or potential negative publicity. This failure to investigate would violate regulatory requirements for addressing potential misconduct and would expose the firm to significant legal and reputational risks. Furthermore, it would undermine the firm's commitment to a culture of compliance and deter future reporting. Another incorrect approach would be to immediately confront the individual accused of misconduct based solely on the whistleblower's report, without conducting a preliminary, confidential assessment. This could lead to premature accusations, damage the reputation of the accused if the allegations are unfounded, and potentially reveal the identity of the whistleblower, thereby exposing them to retaliation. This action breaches principles of due process and confidentiality. A third incorrect approach would be to attempt to identify and question the whistleblower directly about their sources or motives before initiating a formal investigation. This could be perceived as an attempt to intimidate or discredit the whistleblower, directly contravening whistleblower protection provisions. It also risks compromising the integrity of the investigation by introducing bias or creating a hostile environment for reporting. The professional decision-making process for similar situations should involve a structured approach. 1. Receive and acknowledge the report, ensuring the whistleblower understands their rights and protection. 2. Assess the initial information for credibility and potential risk without making premature judgments. 3. Initiate a confidential and objective investigation following established protocols. 4. Maintain strict confidentiality throughout the process, protecting the identity of the whistleblower and the integrity of the investigation. 5. Ensure no retaliatory actions are taken against the whistleblower. 6. Document all steps taken and decisions made. Question 6. Compliance review shows that a critical project is significantly over budget. The project manager is under pressure to implement immediate cost-saving measures. Which of the following approaches best aligns with the principles of controlling project costs within the CRM control of risk framework? Option A. Conduct a thorough review of project expenditures against the approved scope and budget, identifying areas for value engineering and efficiency improvements that do not compromise essential deliverables or regulatory compliance. Option B. Implement arbitrary cuts across all project budget lines to achieve a predetermined percentage reduction, regardless of the impact on project scope or quality. Option C. Defer all non-essential maintenance and quality assurance activities until the project is back on budget, with the intention of addressing them later. Option D. Expedite procurement of materials and services by bypassing standard approval processes and seeking informal agreements to secure lower prices. The correct answer is A. Conduct a thorough review of project expenditures against the approved scope and budget, identifying areas for value engineering and efficiency improvements that do not compromise essential deliverables or regulatory compliance. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need to control project costs with the long-term implications of those cost-saving measures on the project's quality, scope, and ultimately, its success. The pressure to reduce expenditure can lead to decisions that compromise essential project elements, potentially violating regulatory requirements or ethical obligations to stakeholders. Careful judgment is required to ensure that cost control is achieved through responsible and compliant means. Correct approach involves a systematic review and prioritization of project expenditures against the approved budget and scope, seeking efficiencies and value engineering without compromising essential deliverables or regulatory compliance. This aligns with the principles of sound financial management and project governance expected under the CRM control of risk framework, which emphasizes responsible resource allocation and risk mitigation. Specifically, it upholds the ethical duty to deliver the project as agreed and within reasonable parameters, while also adhering to any specific financial control regulations that may be in place. An incorrect approach that focuses solely on arbitrary cuts without considering the impact on project scope or quality is professionally unacceptable. This could lead to a failure to meet contractual obligations or regulatory standards, potentially resulting in project failure, reputational damage, and legal repercussions. Such an approach disregards the fundamental responsibility to deliver a project that meets its objectives and complies with all applicable rules. Another incorrect approach that involves deferring essential maintenance or quality assurance activities to save immediate costs is also professionally unsound. This creates significant future risks, potentially leading to system failures, safety hazards, or non-compliance with operational standards, all of which are contrary to the core principles of risk control and responsible project management. A further incorrect approach that involves circumventing established procurement procedures or seeking unauthorized waivers to expedite purchases for cost reduction purposes undermines the integrity of financial controls and introduces significant compliance and fraud risks. This violates principles of transparency, accountability, and adherence to established governance frameworks. The professional decision-making process for similar situations should involve a thorough understanding of the project's objectives, scope, and budget. It requires a proactive identification of potential cost-saving opportunities through value engineering and process optimization. Crucially, any proposed cost-saving measures must be rigorously assessed for their impact on project deliverables, quality, timelines, and regulatory compliance. Consultation with relevant stakeholders, including project sponsors and technical experts, is essential to ensure that decisions are informed and aligned with overall project goals and risk appetite. Adherence to established financial control policies and procedures is paramount. Question 7. The control framework reveals that a client has lodged a formal complaint alleging that the financial advice received was unsuitable, leading to significant investment losses. The firm's initial reaction is to point to the client's signed advisory agreement, which acknowledges the risks involved. As the head of compliance, what is the most appropriate immediate course of action to manage the potential legal liabilities and regulatory scrutiny? Option A. Conduct a comprehensive review of the client's complaint against the firm's policies and relevant FCA handbook provisions. Engage with the client to understand their concerns and explore resolution options based on the findings. Option B. Inform the client that their signed agreement absolves the firm of any responsibility for investment losses, and therefore no further action is required. Option C. Advise the client that the firm will consider their complaint at its earliest convenience, but provide no specific timeline for a response or investigation. Option D. Immediately offer the client a substantial financial settlement to avoid any further escalation or reputational damage without conducting an investigation. The correct answer is A. Conduct a comprehensive review of the client's complaint against the firm's policies and relevant FCA handbook provisions. Engage with the client to understand their concerns and explore resolution options based on the findings. Explanation. The control framework reveals a potential gap in managing legal liabilities arising from the firm's advisory services. This scenario is professionally challenging because it requires balancing the firm's duty to its clients with its legal obligations and the need to protect its reputation and financial stability. A proactive and compliant approach to managing legal liabilities is paramount. The correct approach involves the head of compliance undertaking a thorough review of the client's complaint, cross-referencing it against the firm's internal policies, procedures, and relevant regulatory guidance from the Financial Conduct Authority (FCA) handbook, specifically focusing on conduct of business rules and principles of treating customers fairly. This includes assessing whether the advice provided met the required standards of suitability, appropriateness, and disclosure. The head of compliance should then engage with the client in a transparent and constructive manner, seeking to understand their concerns fully and exploring potential resolutions, which may include offering redress if a breach of regulatory requirements is identified. This approach aligns with the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, and the overarching objective of ensuring market integrity and consumer protection. It demonstrates a commitment to resolving issues fairly and efficiently, thereby mitigating the risk of formal regulatory action or costly litigation. An incorrect approach would be to dismiss the complaint outright without a proper investigation, citing the client's agreement to the terms of service. This fails to acknowledge the firm's ongoing regulatory obligations and the FCA's expectation that firms will handle complaints fairly and promptly. Such a dismissal could be seen as a breach of Principle 6 and could lead to significant regulatory sanctions and reputational damage. Another incorrect approach would be to offer a settlement to the client immediately without conducting any due diligence or investigation into the merits of the complaint. While appearing conciliatory, this could set a precedent for future claims and may not address the root cause of the issue, potentially leading to recurring problems. It also risks being perceived as an admission of fault without proper justification, which could be detrimental if the matter escalates. A further incorrect approach would be to delay responding to the client's complaint indefinitely, hoping it will be forgotten. This is a clear violation of regulatory requirements regarding complaint handling timelines and demonstrates a lack of respect for the client's concerns and the regulatory process. Such inaction would almost certainly result in a formal investigation by the FCA and potential penalties. Professionals should adopt a structured decision-making process that prioritizes regulatory compliance and ethical conduct. This involves 1. Acknowledging and recording the complaint promptly. 2. Conducting a thorough and objective investigation, referencing all relevant internal policies and external regulations. 3. Communicating transparently and empathetically with the client throughout the process. 4. Determining the appropriate course of action based on the findings of the investigation, which may include offering a fair resolution. 5. Documenting all steps taken and decisions made for future reference and audit purposes. Question 8. Comparative studies suggest that the implementation of new IT systems can introduce significant control risks. A financial services firm is preparing to launch a new client relationship management (CRM) system that will handle sensitive client data and transaction information. The IT department has provided a high-level overview of the system's security features, and the vendor has offered a standard implementation package. The firm's compliance officer needs to ensure the new system's controls are adequate to meet regulatory requirements and protect client data. Which of the following approaches best ensures the firm meets its obligations? Option A. Conduct a thorough review of the system's IT general controls, including access management, change management, and segregation of duties, and independently test the application controls that govern data input, processing, and output to ensure accuracy, completeness, and validity. Option B. Rely on the vendor's documentation and assurances regarding the system's security and functionality, assuming their standard implementation meets all necessary compliance standards. Option C. Prioritize the user interface and ease of use for client-facing staff, ensuring the system is intuitive and efficient for daily operations, with a secondary focus on underlying technical controls. Option D. Expedite the system's deployment to meet urgent business needs, with a plan to address any identified control weaknesses or compliance issues in a post-implementation review. The correct answer is A. Conduct a thorough review of the system's IT general controls, including access management, change management, and segregation of duties, and independently test the application controls that govern data input, processing, and output to ensure accuracy, completeness, and validity. Explanation. This scenario presents a professional challenge due to the inherent complexity of IT controls and the critical need to balance operational efficiency with robust security and compliance. The firm is facing a situation where a new system implementation directly impacts the integrity and confidentiality of client data, necessitating a thorough understanding of both general and application controls. The challenge lies in identifying the most effective and compliant method to ensure the new system meets regulatory expectations without unduly hindering business operations. Careful judgment is required to discern between superficial checks and substantive controls that genuinely mitigate risk. The correct approach involves a comprehensive review of the new system's IT general controls, and application controls. This includes assessing access management, change management, and segregation of duties within the framework, as well as verifying the accuracy, completeness, and validity of data processing within the application itself. This approach is correct because it directly addresses the core requirements of regulatory frameworks like those governing financial services, which mandate strong internal controls over financial reporting and data processing. Specifically, it aligns with principles of risk management and data integrity, ensuring that the system operates as intended and that data is protected from unauthorized access or modification. This proactive and detailed assessment is crucial for demonstrating compliance and preventing potential breaches or errors that could have significant financial and reputational consequences. An incorrect approach would be to solely rely on the vendor's assurances regarding the system's security and functionality. This fails to acknowledge the firm's ultimate responsibility for its own internal controls and data security. Regulatory bodies expect firms to conduct their own due diligence and independent verification, not to outsource this critical function entirely. This approach risks overlooking specific vulnerabilities or misconfigurations that are unique to the firm's operating environment. Another incorrect approach would be to focus only on the user interface and functionality without delving into the underlying and application controls. While a user-friendly interface is desirable, it does not guarantee the integrity or security of the data being processed. This approach neglects the fundamental mechanisms that ensure data accuracy, prevent unauthorized access, and maintain the overall reliability of the system, thereby failing to meet regulatory expectations for robust control environments. A further incorrect approach would be to implement the system quickly to meet business deadlines and address control deficiencies only after issues arise. This reactive strategy is highly risky and contrary to regulatory principles that emphasize a proactive and preventative approach to risk management. It significantly increases the likelihood of data breaches, errors, and noncompliance, which can lead to substantial penalties and reputational damage. The professional reasoning process for similar situations should involve a structured risk assessment framework. This begins with identifying the specific regulatory requirements applicable to the firm and the new system. Next, a thorough understanding of the system's architecture and data flows is essential. This should be followed by a detailed evaluation of both and application controls, using a combination of documentation review, interviews, and testing. Any identified gaps should be prioritized based on their potential impact and likelihood, and remediation plans should be developed and tracked. Finally, ongoing monitoring and periodic reassessment of controls are crucial to ensure their continued effectiveness. Question 9. Benchmark analysis indicates that a firm's largest client, responsible for a substantial portion of revenue, has requested a relaxation of certain risk controls related to their trading activities, citing operational efficiency. The compliance officer has identified potential risks associated with this request, including increased market volatility exposure and potential for regulatory breaches. How should the firm's risk management function approach this situation? Option A. Immediately approve the client's request to maintain the strong client relationship and avoid potential loss of business, assuming the client's operational efficiency arguments are valid. Option B. Inform the client that their request cannot be accommodated due to the firm's strict adherence to internal policies, without exploring any potential compromises or alternative solutions. Option C. Delegate the decision-making entirely to the sales team, as they are best positioned to understand the client's commercial needs and manage the relationship. Option D. Conduct a comprehensive risk assessment of the client's request, evaluating the potential impact and likelihood of identified risks, and propose alternative mitigation strategies that satisfy both the client's operational needs and the firm's regulatory obligations. The correct answer is D. Conduct a comprehensive risk assessment of the client's request, evaluating the potential impact and likelihood of identified risks, and propose alternative mitigation strategies that satisfy both the client's operational needs and the firm's regulatory obligations. Explanation: this scenario is professionally challenging because it requires balancing the immediate financial pressures of a key client with the firm's overarching duty to manage risk effectively and adhere to regulatory requirements. The temptation to overlook or downplay identified risks to retain a significant revenue stream is a common ethical dilemma in financial services. Careful judgment is required to ensure that client relationships do not compromise the firm's integrity or its compliance obligations. The correct approach involves a structured risk assessment process that prioritizes the identification, evaluation, and mitigation of risks, irrespective of the client's importance. This aligns with the core principles of risk management, mandated by the CRM Control of Risk Exam Framework, which emphasizes a proactive and objective approach to risk. Specifically, the regulatory framework requires firms to establish and maintain robust systems and controls to identify and manage risks that could impact their ability to conduct business in an orderly and professional manner. This includes understanding the nature and extent of risks associated with client activities and ensuring that appropriate measures are in place to control them. An incorrect approach would be to accept the client's assurances without independent verification or to dismiss the identified risks as minor due to the client's status. This failure to conduct a thorough and objective risk assessment directly contravenes the regulatory requirement to have adequate systems and controls in place. It also represents a breach of ethical duty, as it prioritizes commercial interests over the firm's responsibility to manage risk prudently. Furthermore, ignoring or downplaying identified risks can expose the firm to significant reputational damage, regulatory sanctions, and financial losses if those risks materialize. Professionals should employ a decision-making framework that begins with a clear understanding of the firm's risk appetite and regulatory obligations. When faced with a conflict between client demands and risk management principles, the process should involve 1. Objective identification and assessment of the risk, using established methodologies. 2. Evaluation of the potential impact and likelihood of the risk materializing. 3. Consideration of available mitigation strategies and their effectiveness. 4. Escalation of significant risks to appropriate senior management or risk committees for decision-making, especially when client relationships are involved. 5. Documentation of the risk assessment process and the rationale for any decisions made. This structured approach ensures that decisions are based on sound risk management principles and regulatory compliance, rather than short-term commercial pressures. Question 10. Investigation of the effectiveness of a financial institution's risk assessment process under Basel III. A risk manager is presented with an opportunity to reclassify certain assets to significantly reduce the institution's risk-weighted assets, RWA, and thereby lower its capital requirements. Proposed reclassification is technically permissible under a narrow interpretation of existing guidelines, but relies on assumptions about future market stability that are not fully supported by recent economic indicators. Which approach best aligns with the principles of Basel III for risk assessment? Option A. Reduce the scope of ongoing risk monitoring for the reclassified assets to minimize operational costs associated with their management. Option B. Seek an external audit opinion that supports the reclassification, assuming this will satisfy regulatory scrutiny regardless of the underlying risk assessment. Option C. Proceed with the reclassification immediately to realize the capital benefits, as it adheres to the letter of the current regulatory guidelines. Option D. Conduct a comprehensive stress test incorporating plausible but severe downside scenarios to assess the impact of the reclassification on capital adequacy under adverse conditions, and ensure the underlying assumptions are robust and defensible. The correct answer is D. Conduct a comprehensive stress test incorporating plausible but severe downside scenarios to assess the impact of the reclassification on capital adequacy under adverse conditions, and ensure the underlying assumptions are robust and defensible. Explanation: this scenario is professionally challenging because it requires a risk manager to balance the immediate need for capital efficiency with the long-term stability and integrity of the financial institution, as mandated by Basel III. The pressure to reduce capital requirements can lead to overlooking critical risk factors. Careful judgment is required to ensure that risk mitigation strategies are robust and compliant, rather than merely cosmetic. The correct approach involves a comprehensive and forward-looking assessment of all material risks, including those that may not be immediately apparent or easily quantifiable. This includes considering the interconnectedness of risks and the potential for stress events to exacerbate existing vulnerabilities. Regulatory justification stems directly from the core principles of Basel Roman III, which aim to strengthen bank capital adequacy, stress testing, and market discipline. Specifically, the framework emphasizes a holistic view of risk and the need for robust risk management practices that can withstand adverse economic conditions. Ethical justification lies in the duty of care owed to depositors, investors, and the broader financial system to maintain solvency and prevent systemic risk. An incorrect approach that focuses solely on optimizing for current regulatory capital ratios without a thorough assessment of underlying risks is ethically and regulatorily deficient. This fails to uphold the spirit of Basel Roman III, which is to ensure resilience. Such an approach could lead to undercapitalization against unforeseen events, potentially jeopardizing the institution's stability and the financial system. Another incorrect approach that prioritizes short-term cost savings by reducing risk management resources or expertise would be a direct violation of the prudential requirements of Basel Roman III. This undermines the institution's ability to identify, measure, monitor, and control risks effectively, creating significant vulnerabilities. A third incorrect approach that relies on historical data alone without incorporating forward-looking stress testing and scenario analysis would be insufficient. Basel Roman III explicitly requires institutions to consider potential future shocks, and a purely backward-looking assessment would fail to prepare for systemic risks or emerging threats. Professionals should employ a decision-making framework that begins with a clear understanding of the regulatory objectives, e.g., Basel Roman III focus on resilience and capital adequacy. This should be followed by a thorough risk identification and assessment process that considers both quantitative and qualitative factors and incorporates forward-looking elements. The institution's risk appetite and tolerance levels must guide all decisions. Finally, a robust governance structure with independent oversight is crucial to challenge assumptions and ensure that risk management practices align with both regulatory requirements and ethical obligations. Question 11. Strategic planning requires a firm to effectively leverage historical data to anticipate and mitigate future risks. Which of the following approaches best demonstrates a robust and compliant methodology for using historical data to predict future risks within the regulatory framework? Option A. Analyzing historical risk events, considering their frequency, severity, and underlying causes, and then applying appropriate statistical models and expert judgment to forecast potential future occurrences, while also accounting for evolving market and regulatory conditions. Option B. Prioritizing the analysis of only the most catastrophic historical risk events, regardless of their frequency, to ensure that the firm is prepared for extreme scenarios. Option C. Focusing exclusively on the most recent year's risk incidents to identify emerging trends, assuming that recent patterns are the most reliable indicators of future events. Option D. Extrapolating historical data directly into the future, without considering any external factors or changes in the firm's operating environment, assuming past performance is a perfect predictor of future outcomes. The correct answer is A. Analyzing historical risk events, considering their frequency, severity, and underlying causes, and then applying appropriate statistical models and expert judgment to forecast potential future occurrences, while also accounting for evolving market and regulatory conditions. Explanation. This scenario is professionally challenging because it requires a firm to balance the imperative of proactive risk management with the practical limitations and potential biases inherent in historical data. The firm must demonstrate due diligence in its risk assessment processes, ensuring that its predictions are robust and defensible, rather than merely reactive or based on incomplete information. This involves a critical evaluation of the methodologies used to interpret past events and project future vulnerabilities. The correct approach involves a nuanced analysis of historical data, considering the context, frequency, and severity of past risk events, and then applying statistical models and expert judgment to forecast potential future occurrences. This methodology is aligned with regulatory expectations for robust risk management frameworks, which mandate that firms take reasonable steps to identify, assess, and mitigate risks. Specifically, it reflects the principles of sound governance and control, ensuring that risk assessments are not superficial, but are grounded in a thorough understanding of the firm's operational environment and potential threats. This approach demonstrates a commitment to proactive risk management, a key tenet of regulatory compliance. An incorrect approach that relies solely on the most recent historical data fails to account for cyclical patterns or the potential for outlier events that may not be represented in short-term trends. This can lead to an underestimation of risk. Another incorrect approach that focuses only on the most severe historical events, without considering their frequency or likelihood, can lead to an overestimation of risk and inefficient allocation of resources. A third incorrect approach that disregards the impact of external market changes or evolving regulatory landscapes on historical data renders the predictions irrelevant and potentially misleading. These approaches are professionally unacceptable as they do not constitute a comprehensive or objective assessment of risk, potentially exposing the firm to unforeseen losses and regulatory sanctions for inadequate risk management. Professionals should employ a decision-making framework that begins with clearly defining the scope of the risk assessment. This involves identifying the types of risks to be analyzed and the relevant historical periods. Subsequently, data should be collected and cleansed, ensuring accuracy and completeness. The analysis should then involve applying appropriate statistical techniques and qualitative judgment to identify trends, correlations, and potential drivers of risk. Finally, the findings should be documented, communicated to relevant stakeholders, and used to inform strategic decisions and control measures. This iterative process ensures that risk predictions are dynamic and responsive to changing conditions. Question 12. Quality control measures reveal that a significant number of expense reports submitted by a particular department have lacked proper supporting documentation, leading to potential overpayments and misstated financial reporting. The department head, aware of these issues, has instructed the accounting staff to process these reports without further delay to meet quarterly financial targets. What is the most appropriate course of action for the accounting staff? Option A. Immediately escalate the identified control deficiencies and the department head's directive to senior management and the audit committee, requesting guidance on remediation and proper processing procedures. Option B. Inform the department head that the expense reports cannot be processed without proper documentation and suggest they be resubmitted correctly. Option C. Conduct a limited internal review of the expense reports to identify the most egregious errors and process only those that appear to be legitimate, deferring the rest. Option D. Process the expense reports as instructed by the department head to ensure timely financial reporting and address the documentation issues at a later date. Correct answer is A. Immediately escalate the identified control deficiencies and the department head's directive to senior management and the audit committee, requesting guidance on remediation and proper processing procedures. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for accurate financial reporting with the potential for reputational damage and the ethical obligation to uphold internal control principles. The pressure to present a positive financial outlook can tempt individuals to overlook or downplay control deficiencies. Careful judgment is required to ensure that the company's commitment to robust internal controls, as outlined by frameworks like COSO, is maintained even when faced with adverse findings. The correct approach involves immediately escalating the identified control deficiencies to senior management and the audit committee. This aligns with the COSO framework's principle of the entity selects and develops control activities that contribute to the mitigation of risks to the achievement of objectives to acceptable levels. By reporting the issues promptly, the company demonstrates a commitment to transparency and proactive risk management. This also fulfills the ethical duty to report material weaknesses in internal control, which is crucial for maintaining investor confidence and regulatory compliance. The COSO framework emphasizes the importance of information and communication, stating that the entity obtains or generates and uses relevant, quality information to support the functioning of internal control. Prompt reporting ensures that relevant information about control weaknesses reaches those who can implement corrective actions. An incorrect approach would be to attempt to remediate the control deficiencies internally without proper documentation or escalation, hoping to avoid scrutiny. This fails to uphold the COSO principle of the entity, demonstrates commitment to integrity and ethical values, and the entity holds individuals accountable for their respective internal control responsibilities. Concealing or delaying the reporting of control weaknesses undermines the integrity of the financial reporting process and can lead to more significant issues down the line. Another incorrect approach would be to dismiss the findings as minor or isolated incidents without a thorough investigation. This directly contravenes the COSO principle of the entity selects and develops control activities that contribute to the mitigation of risks to the achievement of objectives to acceptable levels. Ignoring potential control gaps, even if they appear small, can create vulnerabilities that could be exploited or lead to larger systemic failures. A third incorrect approach would be to focus solely on the financial impact of the control deficiencies without considering the broader implications for the control environment. While financial reporting is a key objective, the COSO framework emphasizes that internal control is a process designed to provide reasonable assurance regarding the achievement of objectives in three categories: operations, reporting, and compliance. Overlooking the impact on the overall control environment can lead to a culture where control weaknesses are normalized. The professional decision-making process in such situations should involve 1. Understanding the nature and severity of the identified control deficiencies. 2. Consulting relevant internal control policies and procedures, referencing the COSO framework. 3. Assessing the potential impact of the deficiencies on financial reporting operations and compliance. 4. Communicating findings and recommendations to the appropriate levels of management and governance. 5. Collaborating on the development and implementation of a remediation plan. 6. Ensuring proper documentation of all steps taken. Question 13. The review process indicates that the organization is facing a period of significant economic uncertainty, characterized by rising inflation and potential interest rate increases. To assess the impact of these changes on the organization, which of the following approaches would best align with regulatory expectations for robust risk management and stakeholder consideration? Option A. Focusing primarily on the immediate impact on the firm's current profit and loss statement and balance sheet, as these are the most direct indicators of financial health. Option B. Analyzing how competitors are likely to react to these economic shifts and adjusting the firm's strategy based on anticipated competitor actions. Option C. Conducting a thorough analysis of how these economic changes might affect the firm's capital adequacy, liquidity, operational resilience, and client service delivery, by gathering input from all relevant internal departments and external stakeholders such as clients, suppliers, and regulators. Option D. Prioritizing the assessment of how these economic changes might influence the achievement of senior management's performance targets and associated remuneration. The correct answer is C. Conducting a thorough analysis of how these economic changes might affect the firm's capital adequacy, liquidity, operational resilience, and client service delivery, by gathering input from all relevant internal departments and external stakeholders such as clients, suppliers, and regulators. Explanation: this scenario is professionally challenging because assessing the impact of economic changes on an organization requires a nuanced understanding of both macroeconomic trends and the specific vulnerabilities and strengths of the firm. It demands foresight, the ability to connect disparate pieces of information, and a commitment to proactive risk management, all within the framework of regulatory expectations. The challenge lies in moving beyond superficial observations to a deep, actionable analysis that informs strategic decision-making and ensures the firm's resilience. The correct approach involves a comprehensive stakeholder perspective, recognizing that economic shifts affect various groups differently and that their insights are crucial for a holistic assessment. This approach aligns with regulatory expectations for robust risk management, which mandates considering all relevant internal and external factors. Specifically, the UK's Financial Conduct Authority, FCA, in its Conduct of Business Rules and Supervisory Expectations, emphasizes the need for firms to understand their business environment and the potential impact of external factors on their ability to meet regulatory obligations and serve customers. A stakeholder-centric view ensures that the assessment considers the firm's operational capacity, its clients' financial well-being, and the broader market implications, all of which are critical for maintaining market integrity and consumer protection, core tenets of the FCA's mandate. An incorrect approach that focuses solely on immediate financial reporting metrics fails to capture the forward-looking nature of economic impact assessment. While financial reports are important, they are historical. Economic changes, such as interest rate hikes or shifts in consumer confidence, have future implications that may not yet be reflected in current figures. This narrow focus risks overlooking emerging threats and opportunities, potentially leading to a breach of the duty to act with due skill, care, and diligence, as expected by the FCA. Another incorrect approach that prioritizes only the impact on senior management's bonus structures is ethically unsound and regulatorily deficient. This approach is self-serving and ignores the broader responsibilities of the firm to its clients, employees, and the market. It creates a conflict of interest and undermines the principle of treating customers fairly. The FCA expects firms to prioritize client interests and to manage risks in a way that safeguards the firm's long-term viability and its ability to serve its customers, not just the short-term financial gains of a select few. A third incorrect approach that exclusively considers the impact on competitor firms, while potentially informative, is insufficient on its own. Understanding competitor reactions is part of market analysis, but it does not directly address the firm's own internal vulnerabilities or its direct impact on its own stakeholders. The regulatory framework requires a firm to understand its own risk profile and its direct responsibilities, not just to react to or anticipate competitor moves. This limited scope fails to provide a comprehensive assessment of the firm's own resilience and its ability to meet its regulatory obligations. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying potential economic changes, then analyzing their potential impact across different business functions and stakeholder groups. It requires gathering diverse inputs, critically evaluating the information, and developing mitigation strategies. Professionals must always consider their regulatory obligations, ethical duties, and the firm's strategic objectives to ensure a balanced and effective response to economic volatility. Question 14. System analysis indicates a firm has identified a significant operational risk related to potential cyber attacks on its client data management system, which could lead to unauthorized access and potential loss or compromise of client assets. The firm is considering its options for addressing this risk. Which of the following represents the most appropriate risk treatment option in line with regulatory expectations for client asset protection and operational resilience? Option A. Implementing enhanced cybersecurity protocols, conducting regular vulnerability assessments, and providing ongoing staff training on data security best practices. Option B. Accepting the risk as a cost of doing business and relying on existing, basic security measures. Option C. Discontinuing the service that generates this specific operational risk to eliminate it entirely. Option D. Purchasing comprehensive cyber insurance to cover any potential financial losses arising from a successful cyber attack. Correct answer is A. Implementing enhanced cybersecurity protocols, conducting regular vulnerability assessments, and providing ongoing staff training on data security best practices. Explanation. This scenario presents a professional challenge because it requires a firm to balance its commercial objectives with its regulatory obligations concerning client asset protection. The firm must make a judgment call on how to best manage a significant operational risk that could impact client funds, necessitating a thorough understanding of the available risk treatment options and their implications under the relevant regulatory framework. The correct approach involves mitigation. Mitigation acknowledges the existence of the risk and seeks to reduce its likelihood or impact. In this context, implementing robust cybersecurity measures, regular system audits, and comprehensive employee training directly addresses the identified vulnerability. This aligns with the regulatory expectation that firms take reasonable steps to safeguard client assets and maintain the integrity of their operations. The regulatory framework, such as the FCA's Principles for Businesses, specifically Principle 3, Adequate Financial Resources, and Principle 7, Communications with Clients, which implies the need for secure systems to protect client information and assets, mandates that firms act with due skill, care, and diligence, which includes proactive risk management, Acceptance of the risk without any countermeasures would be a regulatory failure. This approach demonstrates a disregard for the potential harm to clients and a failure to meet the firm's duty of care. It would likely breach regulatory requirements for client asset protection and operational resilience. Transferring the risk, for instance, solely through insurance, might seem appealing but is often insufficient on its own. While insurance can cover financial losses, it does not absolve the firm of its primary responsibility to prevent the risk from materializing. Regulators expect firms to have direct controls in place, not just to rely on a third party to compensate for losses after the fact. Relying solely on insurance could be seen as an abdication of responsibility. Avoidance of the risk, by ceasing the specific service that generates this operational risk, might be a valid option in some extreme cases, but in this scenario, it would likely be commercially unviable and potentially detrimental to the firm's business model. While avoidance is a legitimate risk treatment option, it is not always the most practical or proportionate response, especially when the risk can be effectively managed through other means. The regulatory expectation is for firms to manage risks prudently, not necessarily to eliminate all activities that carry any risk. Professionals should approach such situations by first conducting a thorough risk assessment to understand the nature, likelihood, and potential impact of the risk. They should then evaluate each risk treatment option against regulatory requirements, ethical considerations, and business objectives. The chosen approach must be demonstrably effective in managing the risk to an acceptable level, with clear documentation of the decision-making process and the rationale behind the chosen treatment. Question 15. Assessment of the most appropriate strategy for a UK-based financial advisory firm to ensure client data privacy and protection, considering the requirements of the Data Protection Act 2018 and UK GDPR. Option A. Store sensitive client financial information on unencrypted USB drives for easy access by authorized personnel. Option B. Share anonymized client data with third-party analytics providers for market research purposes without explicit client consent. Option C. Rely on basic password protection for all client data files stored on company servers. Option D. Implement a multi-layered security approach including encryption, access controls, data minimization policies, regular staff training, and a clear data retention and disposal schedule. The correct answer is D. Implement a multi-layered security approach including encryption, access controls, data minimization policies, regular staff training, and a clear data retention and disposal schedule. Explanation. This scenario is professionally challenging because it requires balancing the operational need for client data with the stringent legal and ethical obligations to protect that data. The firm's reputation, client trust, and potential regulatory penalties hinge on its ability to implement robust data privacy measures. Careful judgment is required to ensure that all data handling practices comply with the relevant regulatory framework, which in this context is the UK's Data Protection Act 2018, DPA 2018, and the UK GDPR. The correct approach involves implementing a comprehensive data protection strategy that includes technical and organizational measures to safeguard client information. This means not only encrypting data, but also establishing clear policies for data access, retention, and disposal, alongside regular staff training on data privacy best practices. This approach is right because it directly addresses the core principles of the UK GDPR and DPA 2018, such as data minimization, integrity and confidentiality, and accountability. It demonstrates a proactive commitment to protecting personal data, which is a legal requirement and an ethical imperative for financial services firms. An incorrect approach that relies solely on basic password protection for client data is professionally unacceptable. This fails to meet the standard of appropriate technical and organizational measures required by Article 32 of the UK GDPR. Password protection alone is often insufficient to prevent unauthorized access, especially in the face of sophisticated cyber threats. It also neglects other critical aspects of data protection, such as data minimization and purpose limitation. Another incorrect approach that involves sharing client data with third-party marketing firms without explicit consent is a severe regulatory and ethical failure. This violates the principles of lawful processing, consent, and purpose limitation under the UK GDPR. It exposes the firm to significant penalties under the DPA 2018 and erodes client trust. A third incorrect approach that involves storing client data on unencrypted personal devices for convenience is also professionally unacceptable. This demonstrates a disregard for data security and confidentiality, creating a high risk of data breaches. It directly contravenes the requirement for appropriate security measures and the principle of integrity and confidentiality. The professional decision-making process for similar situations should involve a thorough risk assessment of all data handling activities. This includes identifying the types of personal data processed, the purposes for processing, and the potential risks to individuals' rights and freedoms. Based on this assessment, firms must implement appropriate technical and organizational measures to mitigate these risks, ensuring compliance with the UK GDPR and DPA 2018. Regular reviews and updates of data protection policies and procedures are also crucial to adapt to evolving threats and regulatory guidance. Question 16. Upon reviewing the initial risk assessment for a new product launch, a control risk manager is planning a brainstorming session with the product development and compliance teams to identify potential control weaknesses and emerging risks. Which of the following facilitation approaches would best support the objectives of this session within the CRM control of risk framework? Option A. Encourage participants to build upon existing ideas and avoid introducing entirely new or potentially disruptive concepts to maintain a streamlined discussion. Option B. Primarily solicit ideas from the most senior members of the product development team, as their experience is likely to cover the most significant risks. Option C. Facilitate the session by encouraging open idea generation from all participants, actively probing for potential control gaps and new risks, and ensuring a safe environment for all to contribute, followed by a structured method for categorizing and prioritizing identified risks. Option D. Focus the session on generating as many ideas as possible, regardless of their immediate relevance to risk control, with the expectation that the compliance team will filter and assess risks later. The correct answer is C. Facilitate the session by encouraging open idea generation from all participants, actively probing for potential control gaps and new risks, and ensuring a safe environment for all to contribute, followed by a structured method for categorizing and prioritizing identified risks. Explanation. This scenario is professionally challenging because effective brainstorming is crucial for identifying and mitigating risks, a core function within the CRM control of risk framework. The challenge lies in ensuring that the brainstorming process itself does not introduce new risks or fail to uncover existing ones due to poor facilitation. Careful judgment is required to balance open idea generation with the need for structured risk identification and assessment, adhering to regulatory expectations for robust risk management. The correct approach involves actively encouraging diverse perspectives and ensuring all participants feel safe to contribute, while simultaneously guiding the discussion towards identifying potential control failures or new risks. This aligns with the spirit of the CRM control of risk exam, which emphasizes proactive risk identification and the implementation of effective controls. Regulatory guidance typically stresses the importance of a comprehensive and inclusive risk assessment process, where all potential risks, however small they may seem initially, are brought to light. Ethical considerations also demand that all relevant information is considered and that no individual's input is unfairly dismissed, fostering an environment of trust and transparency essential for effective risk management. An incorrect approach that focuses solely on generating a high volume of ideas without any structure for risk identification would fail to meet the objectives of a risk control brainstorming session. This could lead to a superficial understanding of potential risks and a lack of actionable insights, potentially violating regulatory requirements for thorough risk assessment. Another incorrect approach that prioritizes only the most experienced individual's ideas risks overlooking valuable insights from less senior staff, thereby creating blind spots in risk identification and potentially leading to regulatory noncompliance if critical risks are missed. Finally, an approach that discourages dissenting opinions or challenges to initial ideas stifles critical thinking and can lead to groupthink, a significant risk in itself, preventing the identification of latent control weaknesses, and thus failing to uphold the principles of effective risk management expected under the CRM framework. Professionals should employ a decision-making framework that begins with clearly defining the objectives of the brainstorming session, specifically in relation to risk identification and control. They should then select facilitation techniques that encourage broad participation and diverse viewpoints, while also incorporating mechanisms for capturing, categorizing, and prioritizing identified risks. Regular review and adaptation of the facilitation process based on the session's progress and outcomes are also critical. Question 17. Benchmark analysis indicates that a firm is seeking to enhance its risk identification processes. Which of the following brainstorming approaches is most likely to yield a comprehensive and effective identification of potential risks relevant to the firm's operations and regulatory obligations? Option A. A brief meeting of the senior management team to discuss risks based on their collective experience. Option B. Discussion led by the head of compliance, focusing primarily on risks previously identified in regulatory audits. Option C. A review of industry news articles and competitor failures to identify common risks. Option D. A facilitated session involving representatives from all key departments, utilizing scenario-based questioning and what-if analysis to explore potential negative outcomes. The correct answer is D. A facilitated session involving representatives from all key departments, utilizing scenario-based questioning and what-if analysis to explore potential negative outcomes. Explanation. This scenario presents a professional challenge because effectively identifying potential risks requires a systematic and comprehensive approach, moving beyond superficial understanding to uncover latent threats. The challenge lies in ensuring that the brainstorming process is inclusive, encourages open communication, and captures a wide spectrum of potential issues that could impact the firm's compliance, reputation, or financial stability. Careful judgment is required to discern relevant risks from trivial concerns and to prioritize them appropriately for further assessment. The correct approach involves using a structured brainstorming technique that encourages diverse perspectives and facilitates the generation of a broad range of potential risks. This method, by actively soliciting input from various stakeholders and employing techniques like scenario planning or what-if analysis, ensures that a wider array of potential threats, including those that might be overlooked in a less structured discussion, are identified. This aligns with regulatory expectations for robust risk management frameworks, which mandate proactive identification and assessment of risks. Specifically, under the CRM Control of Risk Exam framework, firms are expected to have processes in place that are designed to identify all material risks. A structured, inclusive brainstorming session is a key component of such a process, helping to fulfill the firm's duty of care and regulatory obligations to manage risks effectively. An incorrect approach that relies solely on the most senior management's experience risks overlooking risks that are more apparent to frontline staff or those in specialized departments. Failure to solicit diverse perspectives can lead to a narrow and incomplete risk identification, potentially violating the spirit of comprehensive risk management expected by regulators. Another incorrect approach, focusing only on historical incidents, neglects emerging risks or those that have not yet materialized. While historical data is valuable, it is insufficient on its own to identify future threats, which is a core requirement of proactive risk management. Finally, an approach that prioritizes risks based on immediate perceived impact without a systematic assessment process can lead to misallocation of resources and a failure to address potentially more significant, albeit less immediately obvious, risks. This can contravene regulatory guidance that emphasizes a thorough and objective risk assessment process. Professionals should employ a decision-making framework that begins with understanding the firm's objectives and the regulatory landscape. When identifying risks, this framework should mandate the use of structured and inclusive brainstorming techniques. This involves defining the scope of the brainstorming, selecting appropriate participants from across the organization, and utilizing facilitation methods that encourage open and honest contribution. Following the brainstorming session, a process for categorizing, prioritizing, and documenting identified risks should be implemented, ensuring that the output is actionable and contributes to the overall risk management strategy. Question 18. Performance analysis shows that the firm's compliance monitoring activities have detected a significant number of minor breaches across various business units. In response, the compliance department is considering a new strategy to enhance its control framework, Which of the following approaches best addresses the underlying compliance risk management challenge? Option A. Increase the frequency and scope of transaction monitoring across all business units to capture a greater number of minor breaches, assuming that addressing a higher volume of issues will lead to overall improved compliance. Option B. Focus resources on addressing the business units that have historically generated the most compliance breaches, irrespective of current risk levels or the nature of the breaches. Option C. Standardize the implementation of a new, advanced compliance software solution across all departments, believing that a uniform technological upgrade will inherently strengthen the control environment. Option D. Implement a comprehensive, risk-based review of all business processes, prioritizing the development and enhancement of controls in areas identified as having the highest potential for significant regulatory breaches, even if these areas have a lower volume of activity. The correct answer is D. Implement a comprehensive, risk-based review of all business processes, prioritizing the development and enhancement of controls in areas identified as having the highest potential for significant regulatory breaches, even if these areas have a lower volume of activity. Explanation. This scenario presents a common implementation challenge in compliance risk management, balancing the need for robust controls with the practical realities of business operations and resource constraints. The professional challenge lies in interpreting regulatory requirements not as rigid, static rules, but as principles that must be embedded within a dynamic business environment. A compliance officer must exercise sound judgment to identify where risks are most significant and where controls are most effective, rather than simply applying a one-size-fits-all solution. This requires a deep understanding of the firm's business model, its risk appetite, and the specific regulatory expectations. The correct approach involves a risk-based methodology. This means prioritizing compliance efforts and resources towards areas with the highest inherent compliance risk. It requires a thorough understanding of the firm's activities, the regulatory landscape, and the potential impact of non-compliance. By focusing on high-risk areas, the firm can ensure that its most critical compliance obligations are met effectively, thereby demonstrating a commitment to regulatory adherence and mitigating potential harm to clients and the firm. This aligns with the principles of effective compliance management, which emphasize proportionality and a focus on material risks, an approach that focuses solely on the volume of transactions, without considering the nature of those transactions or the associated regulatory obligations is flawed. This fails to acknowledge that not all transactions carry the same level of compliance risk. For example, a high volume of simple, low-risk transactions might pose less of a compliance challenge than a lower volume of complex, high-risk transactions that involve sensitive client data or intricate regulatory requirements. This approach risks misallocating resources and potentially overlooking significant compliance gaps in areas that appear less active, but are more prone to regulatory breaches. Another incorrect approach would be to implement controls based on historical practices without reassessing their current effectiveness or relevance to evolving regulations. Compliance is not static. Regulations change, business models adapt, and new risks emerge. Relying on outdated controls can lead to a false sense of security while leaving the firm vulnerable to noncompliance. This demonstrates a lack of proactive risk management and a failure to adapt to the dynamic regulatory environment. Finally, an approach that prioritizes the implementation of the most technologically advanced solutions without a clear understanding of their necessity or effectiveness in addressing specific compliance risks is also problematic. While technology can be a valuable tool, its implementation should be driven by a clear risk assessment and a defined objective. Investing in technology for its own sake, without a direct link to mitigating identified compliance risks, can be an inefficient use of resources and may not adequately address the underlying compliance challenges. Professionals should employ a structured decision-making process that begins with a comprehensive risk assessment. This involves identifying all potential compliance risks, evaluating their likelihood and impact, and then prioritizing them. Based on this prioritization, resources and controls should be allocated strategically. Regular review and testing of controls are essential to ensure their ongoing effectiveness and to adapt to changes in the regulatory environment and business operations. This iterative process ensures that compliance efforts are both effective and efficient. Question 19. Implementation of a new client onboarding process has resulted in a significant increase in errors, including incorrect risk profiling and inadequate Know Your Customer kick checks. The compliance department has identified that the root cause is not a lack of training, but rather a poorly designed workflow that is overly complex and prone to human error, exacerbated by insufficient system prompts. The firm must now develop corrective actions. Which of the following represents the most appropriate and regulatorily compliant approach to developing these corrective actions? Option A. Conduct a thorough review of the client onboarding workflow, redesigning it to be more intuitive and incorporating enhanced system validation checks with a clear implementation timeline. Option B. Issue a formal warning to the team responsible for onboarding, holding them accountable for the errors and requiring them to manually double-check all future onboarding cases. Option C. Focus on expediting the onboarding process to clear the backlog of cases, deferring any significant workflow changes until the current workload is managed. Option D. Implement a mandatory refresher training program for all staff involved in client onboarding, emphasizing the importance of adhering to existing procedures. Correct answer is D. Implement a mandatory refresher training program for all staff involved in client onboarding, emphasizing the importance of adhering to existing procedures. Explanation: this scenario is professionally challenging because it requires a firm to move beyond simply identifying a risk event and instead delve into the underlying systemic issues that allowed the event to occur. The firm must demonstrate a proactive and robust approach to risk management, not just reactive remediation. Careful judgment is required to ensure that corrective actions are not superficial, but address the root causes effectively, preventing recurrence and upholding regulatory standards. The correct approach involves a thorough root cause analysis, RCA, that identifies the fundamental reasons for the control failure, followed by the development and implementation of specific, measurable, achievable, relevant, and time-bound, SMART, corrective actions. This approach is justified by the FCA's Financial Conduct Authority Principles for Businesses, particularly Principle 3, Adequate Financial Resources, and Principle 7, Communications with Clients, which implicitly require firms to have robust systems and controls to prevent misconduct and protect consumers. Furthermore, the FCA's supervisory approach emphasizes the importance of firms identifying and addressing the root causes of their failings. Implementing targeted corrective actions demonstrates a commitment to improving internal processes and controls, thereby mitigating future risks and ensuring compliance with regulatory expectations. An approach that focuses solely on disciplinary action against the individual responsible fails to address the systemic issues that may have contributed to the control failure. This is a regulatory failure because it does not prevent similar issues from arising in other parts of the firm or with other individuals, thus not fulfilling the firm's obligation to maintain adequate systems and controls. An approach that involves a superficial review of procedures without a deep dive into why the existing procedures were not followed or were inadequate is also a regulatory failure. This approach risks merely papering over the cracks, failing to address the actual root causes, and leaving the firm vulnerable to repeat occurrences. It demonstrates a lack of commitment to genuine risk mitigation and a failure to meet the FCA's expectations for effective control environments. An approach that prioritizes immediate business continuity over a thorough investigation and remediation plan is a significant regulatory and ethical failure. While business continuity is important, it should not come at the expense of understanding and rectifying the underlying causes of a control breakdown. This approach suggests a culture that may be more concerned with short-term operational pressures than with long-term compliance and client protection, which is contrary to the FCA's emphasis on treating customers fairly and maintaining market integrity. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and report the control failure promptly. 2. Initiate a comprehensive root cause analysis involving relevant stakeholders and potentially external expertise if necessary. 3. Develop a detailed remediation plan with clear ownership, timelines, and measurable outcomes, directly linked to the identified root causes. 4. Implement the remediation plan diligently, with ongoing monitoring and evaluation of its effectiveness. 5. Communicate findings and remediation progress to relevant internal and external parties as required. 6. Embed lessons learned into the firm's risk management framework and culture to foster continuous improvement. Question 20. Which approach would be most effective in identifying the root cause of a potential regulatory breach related to client communication and advice, and in developing sustainable solutions to prevent recurrence, adhering to the principles of robust internal control and client protection. Option A. Relying on the advisor's self-assessment of the situation and implementing minor procedural adjustments based on their feedback. Option B. Conducting a thorough root cause analysis using techniques such as the 5 whys and fishbone diagrams to identify systemic issues and inform corrective actions. Option C. Dismissing the client's concerns as an isolated incident and focusing on other business priorities. Option D. Immediately imposing disciplinary measures on the advisor involved and issuing a general reminder to all staff about communication protocols. The correct answer is B. Conducting a thorough root cause analysis using techniques such as the 5 whys and fishbone diagrams to identify systemic issues and inform corrective actions. Explanation. This scenario presents a professional challenge because it requires a firm to investigate a potential breach of regulatory requirements concerning client communication and advice, while simultaneously managing the reputational and financial risks associated with such an investigation. The firm must balance its duty to clients, its obligations to the regulator, and its internal operational integrity. A systematic and thorough root cause analysis is essential to identify systemic issues rather than superficial symptoms, ensuring that corrective actions are effective and prevent recurrence. The correct approach involves using structured problem-solving techniques like the 5 whys and fishbone diagram to conduct a thorough root cause analysis. This method allows for a deep dive into the underlying reasons for the communication breakdown, moving beyond immediate causes to identify systemic failures in training, processes, or oversight. This aligns with regulatory expectations for firms to have robust internal controls and to proactively identify and address compliance risks. Ethically, it demonstrates a commitment to client welfare by seeking to understand and rectify any shortcomings in advice delivery. The 5 whys by repeatedly asking why to peel back layers of causation, and the fishbone diagram by categorizing potential causes, e.g., people, process, technology, environment, provide a comprehensive framework for uncovering the true origins of the issue. This systematic approach is crucial for demonstrating due diligence to the regulator and for implementing meaningful improvements. An incorrect approach would be to focus solely on disciplinary action against the individual advisor without investigating the systemic factors that may have contributed to the issue. This fails to address the root cause and risks the problem recurring with other advisors or in different contexts. It also overlooks the firm's responsibility to provide adequate training and support. Another incorrect approach would be to implement a superficial fix, such as a one-off training session, without understanding the underlying reasons for the communication failure. This approach is unlikely to be effective in the long term and does not demonstrate a commitment to genuine improvement. It also fails to satisfy regulatory requirements for effective risk management and control. A third incorrect approach would be to dismiss the client's concerns as an isolated incident without proper investigation. This not only risks further client dissatisfaction and potential regulatory scrutiny, but also demonstrates a lack of diligence and a failure to uphold professional standards. Professionals should approach such situations by first acknowledging the seriousness of the complaint and initiating a formal investigation. This investigation should prioritize a root cause analysis using established methodologies like the 5 whys and fishbone diagrams. The findings should then inform the development of targeted remedial actions, which may include process improvements, enhanced training, or system upgrades. Throughout this process, maintaining clear and transparent communication with relevant stakeholders, including the client and the regulator, if required, is paramount. The decision-making process should be guided by regulatory obligations, ethical principles, and a commitment to continuous improvement in client service and compliance.